Jamie Dimon, the CEO of JP Morgan Chase, and also other financial leaders are going to explain to you where they see the next few months in the US economy going, what's going to be happening with rate cuts. And I'm also have a ton of information, updated information on the US economy and things that I am monitoring live in real time. I talk a lot about this in my live chats, but here is all of that research and information. After you watch this video, you're going to have a very good understanding of where the current economy is and where we are going in the future. Let's go.
I think the economy is weakening. You know, whether that is on the way to recession or just weakening, I don't know, and that just confirms what we already thought, kind of.
And I know
that's a big revision.
And speaking of kind of what we were going back to with the state of the economy, the difficulty predicting, one of the questions people have is, what's going on with the consumer right now?
They're still spending money. It's a little bit different depending what income set they're coming from. They still have jobs, so consumers tend to react to that. So the consumers weaken, confidence weaken, you know, corporate profit is still up. And there's a lot of different factors in the economy right now. It's hard to figure out what it all means, you know. And I've always been quite skeptical of most forecasts for that reason. So we just have to wait and see. There's a lot of stimulus out there too. We don't know what the Fed's going to do. They'll probably reduce rates, but I don't think that's going to be consequential to the economy. So we'll see.
They're going to cut next week?
Yeah, they're going to cut. I think they should cut 50. They're going to cut 25, probably. It will depend. You know, the CPI report that's out tomorrow will be interesting, or Thursday will be interesting. Listen, I think they should go 50, but I think they're going to go 25, and then we're going to start moving rate down. That being said, you can still build a portfolio to get this sort of yield. And by the way, you can still stay in the front of the belly of the yield curve, get that yield. We've been extending a little bit out because now your real rates are pretty exciting. Get the things that are interesting. Real rates now, if inflation's running 3-ish, these real rates are actually okay, out the curve now.
Your colleague, former colleague, Jamie Dimon, says the economy is weakening. Do you believe the economy is weakening?
You know, first, I think it's complicated, and I think sound bites are awfully difficult to take out of context. And I put into two categories. Number one is what we see in our own data. The second is what you see more broadly. In our own data, things are remarkably stable. I mean, we look at, I know you guys have talked about it this morning and other times, consumer spend continues at the same year-over-year pace across almost all wealth levels. Consumer credit is as good as it's been in the last 6 months. In fact, it's probably trending a touch better. Companies are in really great shape. We look at signs for any kind of change, and you just don't see it. Having said that, there is this big dichotomy between higher income and lower income consumers, which continues and is a real issue. And when you look at just the overall data in terms of jobs, it's undeniable in terms of just job creation. So yeah, things are actually feel very good today, certainly relative to what you think they could be. But it's not equal across wealth spectrums, and there's probably more downside than upside.
So the high-end, low-end consumer spending, you see it.
All right, let's just move. Like the clip I know was a little bit like laggy there. I do apologize. X was having some technical difficulties. So I also wanted to show you this here real quick.
In my mind, one of the single most important economic questions of the...
This is the Treasurer of the United States, Scott Bessent, kind of telling you where he sees this going. This was back a month or two ago, but just gives you some additional context and where I'm taking this video and what I'm about to show you.
Next few years, will there be a continued decoupling between the world's two largest economies, or is it possible to rebalance together? Senator, President Trump would like the U.S. economy to rebalance toward greater manufacturing, bring down the trade deficit. The Chinese continue to add manufacturing capacity. Currently, they are 30% of global capacity, up substantially since 2020. Under the cover of COVID, they increased capacity. They are in the midst of a substantial real estate downturn. Some would call it a crisis. They have very low consumer spending, and so they need to rebalance to more consumer spending, address their domestic imbalances, but they cannot do that on the workers of the rest of the world. So if they are willing to be good partners and approach a negotiation where the U.S. brings back manufacturing, precision manufacturing, high-paying jobs, and the Chinese are willing to open their economy to American products, then we could do that together.
Okay, so this whole tariffs and trade war is designed to bring back manufacturing jobs to the United States, right? High-paying manufacturing jobs. So let's look at the overall data and the health of the economy. And I actually want to show you some stuff about manufacturing, kind of what that represents on the total job market here in the United States, and if it kind of makes sense to do this, what we're doing right now. So here is the US economy overview. Economic momentum has slowed considerably in 2025 due to factors such as elevated tariffs, tighter monetary policy, and global trade tensions. Real GDP rebounded by 3.3% annualized in quarter two after contracting by 0.05 negative in the first quarter. But overall expansion for the first half of the year was only 1.4%, about half of the 2.8% seen in 2024. Forecasts anticipate sub 1% growth for quarter three and modest improvement in quarter four as fiscal stimulus measures, the One Big Beautiful Bill Act, begin to affect actively. Tariff revenue. Right now, tariff collections in 2025 is $183.6 billion, with a record $31.4 billion collected in August alone. Who pays the tariff? U.S. importers, U.S. businesses pay the tariffs directly. Most studies show that over half of the tariff burden falls on U.S. companies. I actually found a new study, 86% of tariffs are paid by U.S. companies and U.S. consumers. Recent estimates in 2025, U.S. businesses absorb slightly more than half of the tariff costs, and the consumer share price is rise above 67% in the coming months. It's actually much higher. Impact on farmers and businesses. Farmers and U.S. agriculture exports to China dropped 39% year over year, with projected export losses for soybeans exceeding 25 million metric tons and corn exports to China down by as much as 90%. Actually, right now, soybeans and corn, last year we did about $12 to $14 billion to China. This year, nothing. That is a big hit for rural farmers in the middle of the country. The farm trade deficit reached $28.6 billion in the first half of 2025. Unemployment rate is 4.3%. That is rising. In August 2025, the highest since October 2021. Jobs created in August is only 22,000, far below expectations. Annual revision, the U.S. economy added 911,000 fewer jobs from April 2024 to March 2025. Actually, this is interesting because when Biden was leaving office, I had made a comment several times in my live streams that the economy was already slowing down under Biden. And when Trump came in to try to rebalance manufacturing in the United States, the policies that he put in place have actually really slowed down job creation. What's accelerating job loss here is also AI. I don't think people realize that 20 to 25% of all jobs right now will be replaced by AI, artificial intelligence, and robotics over the next few years. So if you have a job right now that you think AI can replace you, you might want to be brushing up on how to use AI so your skills can overmatch the people that you're working for, like people that you're working next to. Because if they look at you and your friend here and you guys have the same resume, but you have AI skills, they'll probably keep you and pay you more. And unfortunately, the issue also here is when you have $186 billion paid by U.S. businesses here, a lot of this is paid by U.S. consumers and businesses. These businesses are looking around to how to save money, right? Because now they don't have an extra $180 billion that they used to have. So what is the easiest and best way to start saving money? Well, getting rid of some employees and start adding AI anywhere they can is going to save them a lot of money in the overall expectation of things. And so I think all of this is going to catch up to us very soon. And unfortunately, this is going to have a lot of negative consequences, in my opinion, going forward. Current inflation rate is about 2.9% in August. Higher prices for food, used cars, and trucks, and a bump in energy costs have contributed to shelter costs rising 0.04 monthly. Core inflation remains steadily at 3.1%. Short term, the Federal Reserve is broadly expected to cut rates by 0.25%. And there's 3 meetings left: September, October, and December. I also wanted to show you some stuff about manufacturing because this whole thing has been about bringing manufacturing back to the United States, but manufacturing only represents 10% of jobs in the United States. So we are doing a lot of this just to bump up a few points here on the 10, maybe 10, 15%. I think this is a very dangerous rope to walk Manufacturing represents 10% of US GDP in 2025, with annual output valued at about 2.9 trillion, with approximately 13 million workers employed in the sector. Rebuilding and expanding US manufacturing at a large scale would take and require at least a decade of coordinated technology upgrades, workforce growth, and supply chain transformation. And current supply chain network faces significant obstacles in supporting rapid reshoring. Manufacturing, like I said, makes up 10%. Sector employment is nearly 13 million jobs, with some of these manufacturing workers earning $100,000 annually. Contribution varies widely by state. Indiana, 26%, and near zero in DC and Wyoming. Manufacturing growth has been sluggish, with the output rising only 0.01% month over month. So we are not seeing manufacturing jobs coming back yet. And if it does take 10 years, you got to understand that President Trump only has a 4-year term. And after his term is done in office, there might be a whole new administration that comes in and does away with a lot of what he's doing here. So you got to understand that we're probably not going to even be able to play out this 10-year or 20-year plan to reshore up manufacturing. Supply chain requirements and current status. Successful scaling depends heavily on resilient, flexible supply chains, including both materials and logistic networks. Efforts like the National Supply Chain Optimization Intelligence Networks are underway to make U.S. supply chains more robust and connect small suppliers to large opportunities, but these initiatives are still in the very early stages. I just want to show you how much time it takes to build out a new manufacturing hub and center with all the supply chain. So I gave you some examples here of other countries that went through all of this and how long it took them. So China, early development in China began in 1978, accelerating in the 1990s, especially after the WTO assertion 2001. Major supply chain efficiency and the global integration took 20 to 30 years. India, transform is ongoing, aided by digitization, infra investments, and substantial e-commerce growth. It took 25 years for India to set up their logistics, warehousing, and integrated global supply chains. Mexico. It took Mexico 30 to 60 years to set up where they are today. So what we're trying to do here in the US isn't a 6-month or year job. This is a decades-long growth and trying to get this opportunity here. I also wanted to show you where most of our GDP actually come from, because it's not manufacturing. The US cannot compete against India and China and Mexico as far as how much a worker is being able to be paid per hour. There was actually an interesting a company that was building products in China and building products in the United States. It's the exact same product, only the US product is $100 more expensive because of cost of labor and other things, right? Like supply chains. How many people bought the US product? 0. No one bought the US product to pay $100 more for the same thing. So even if we bring back this manufacturing, are people going to pay the higher prices compared to cheaper brands and cheaper things other countries? That's a tough question, right? People that have a lot of money probably will buy American, but everybody else is pinching pennies right now and trying to save. And those people are not going to spend the extra money to shop American. Consumer spending, 68%. Finance, insurance, real estate, 21%. Government spending, 17%. Business investment, 18%. Manufacturing, 10%. Services. This is where the US, this is really what the US is focused on. Includes healthcare, professional education. Think about movies or software as a service, banking, infrastructure. This is really what America has been moving towards for the past 20 to 30 years, right? The Internet 1.0, Internet 2, Internet 3, we're trying to really get to this. Exports, 11%. Imports, agriculture, forestry, and fishing, less than 1%. Mining and utilities, under 2%. Transportation and warehouse, 3%. And just, 33% of US states are already in a recession. Moody's Analytics finds that states accounting for 1/3 of US GDP are already high risk of a recession right now. On the other hand, California, Texas, and New York are holding steady, helping stabilize the national economy. So without California, Texas, and New York, the US would be in a world of hurt right now. This is also something that I'm keeping a close eye on. And this is something that you should be paying close attention to, because when you have the stock market at all-time record highs, you start to look around and it really doesn't justify where the economy actually is. What comes up eventually will come back down. Also, US economy is circling the drain. US banks have $600 billion in unrealized losses. The vast majority of millennials can't afford housing. Homelessness is breaking records of 800,000 US citizens. 3 years of record inflation has left daily life unaffordable for half Americans. This is the worst US economy since the Great Depression, probably even worse. Just to give you where this money is coming from here, US banks are currently holding between 400 to 500 billion in unrealized losses and investments in securities, mostly in long-term treasuries and mortgage-backed securities. So when is this system going to break? And is that what people mean by a complete and financial reset? Banks cannot easily sell these assets without realizing losses, which restricts their ability to lend and impairs liquidity, risking additional economic contraction or financial instability. Elevated long-term interest rates are driven those losses. If any reversal of rates, US government annual debt service costs have surged, with the fiscal year deficits now exceeding 1.5 trillion. The US is hurting right now, and it's only going to get worse over the next few months. Rates will come down, but we still have to deal with all of this other stuff. Good luck. Nothing in this video should be taken as financial advice. This is for entertainment purposes only. I am not a financial advisor. Please seek financial advice if you need it. Let's get back to the video.